All right, everybody, welcome along to this Monday afternoon market recap. I just wanted to point out a couple of things that we've been speaking about in that pro analysis class each weekend, which are potentially beginning to play out as at this week. We have been very interested in this gap that did set up between Thursday and Friday last week. Very important. The reason for that is because we speculated whether or not this was going to be potentially that of an exhaustion gap. Now, let me make one thing very clear. We're not talking about an exhaustion of the macro trend to the upside, more so that of the intermediate push off from this macro bullish trend line that we have seen really around Christmas of 2018. The markets have been on an absolute rip to the upside since. It's only really known, or they have really only known one direction, and that has been to continue with their price appreciation. Now, again, we're coming back up very close to the past all-time highs, which are taking us back to the period of September and October 2018. And really, when we drill on back down into the molecular level of, I guess, the daily candlesticks, when you begin to see these types of gaps that potentially exhaust, or soon after the actual gap itself, you begin to see reversal candlesticks, you have to become a little bit concerned about the continuation of price direction to the upside in the immediate future. This picture right here, or at least the trend direction that we have seen since December 2018 to where we currently find ourselves really in the midpoint of April, can change very, very quickly. Now, again, I seem to believe at this particular point that this is not a measuring gap. It isn't going to be that of a gap and go. It isn't going to be that of what we deem to be a continuation gap. In fact, what I believe this is going to turn out to be, as I've already alluded to a couple of minutes ago, is that of an exhaustion gap. And what that exhaustion gap should lead to, unfortunately, is for price itself to begin pulling on back down, which may establish once again that next consecutive higher low. Or what may even happen is we may temporarily overshoot this support over here at 2,800 on the S&P 500. It seems a little hard to believe at the moment, especially when you take into consideration the angle of these exponential moving averages. But when you begin to pay attention to, again, these oscillators that have been rather stretched for a good number of months. I mean, you can take it all the way back really to the early point of February 2019. We're still lingering up and around these current elevated areas in terms of the overbought, overextended nature of this market. And before we can definitively break out, generally speaking, above these past all-time highs, which I think is still very much so on the cards, and I'm not deviating whatsoever away from that, before and up until we can break out and continue to trend further into 2019, it makes a lot of sense that this market is going to give back a portion of these gains that we have priced all the way through to as soon as, or as recently as yesterday, all right, or being that of Monday. So interesting things setting up on the overall markets, the state of the markets. What I would encourage you to really focus on is that of the ADX and the CCI, because again, we've been speaking about this. One of the most important signals that you will get during this type of move, a bounce off from the macro primary bullish trend, is when the actual ADX turns down, signifying the end of the trend. And I'm not talking about, again, the big macro trend. I'm talking more so about this intermediate push that we have established and we have very much been within and a part of since December 2018. Now, again, the ADX hasn't turned down. It's printing at 46. It can go a lot further. But what this is telling us in conjunction or in association with the commodity channel index is that, look, the markets themselves, although they are trending to the upside, we need to allow the ADX to reset. That's really what it's telling us before we can see the trend continuation to new all-time highs. So what we've been speaking about over the past number of weeks is actually taking risk off the table. And as recently as last week, we really just blacklisted ourselves from actually jumping into new bullish trades, because although risk is essentially on at the moment, we can see that very quickly turn off, or at least people take risk off very close to this all-time high. And this little setup here, again, just to explain this to you, it's looking very similar to that of an exhaustion type of gap, right? Not that of a continuation gap, which a lot of people are calling this, mixed with today's candlestick being that of a hangman candle, the S&P 500, although it clawed back a lot of the early losses in the session. It did close down just under 2 points, not the biggest material move, so to speak, but this signal here, after this sort of gap and go that we saw between Thursday and Friday, is another warning signal. It's another shot across the bow when it comes to a potential slowdown, right? And a very short-term reversal, another sort of minor level reversal to take us on back down into another opportunity to re-add 2 positions prior to the bigger move, taking us all the way out, breaking above the all-time highs and trending into 2019 or further into 2019. Now, again, This is the chart of the Dow Jones Industrial Average. We've speculated whether or not this is actually a bull flag continuation. Again, we got the gap between Thursday and Friday. Still calling this potentially what I deem to be that of an exhaustion gap, a little bit of a spinning top, not so much a sort of a hangman, but somewhat similar, I guess you could say. Down 27 points, a rather immaterial day session, but we're still struggling to actually break above the swing high that we printed, and this is going back to the 5th of April. So a little bit of divergence still across the board on these markets. And the final market, by the way, is that of the NASDAQ. The NASDAQ, we've had a target up here at 7,998. We're trading at 7,976. We're very close. We eked, I think, a very brief short-term, another sort of multi-month high today. However, we're still yet to hit our target. But again, if you're in any of these Q trades as far back as 6696 on the upside, or 7595 or 7667, these are all bullish trades and opportunities in the past to re-add to those long opportunities, lose positions or exposure in the market to the upside. I firmly believe right now it's a good opportunity for you to ask yourself the question, do you want to take a percentage, not necessarily all, but bank a bit of a percentage, right, of those profits and put it in your back pocket and allow the market to reset if it chooses to do so on the ADX prior to actually jumping on back in with the trend? Most likely, by the way, it's going to be off probably the 200-day simple moving average. It makes a lot of sense for the markets to actually retrace. I see a lot of people freak out when essentially the markets do, if they choose to, break below what has most recently been that most recent sort of higher swing low. And it makes a lot of sense to the eyes of a relatively skilled technician, may I say, for something like this to actually play out. All right, pay attention to the simple moving averages, but more importantly right now, pay attention to the immediate price action. Again, I would strongly encourage you to really stay away from the market if you're looking to really put risk on at the moment, or at least open up new positions. Now is not the time. The markets haven't confirmed that they're breaking out, nor have we seen any confirmation that they actually want to retrace for the time being. But we're starting to really genuinely see those early reversal signals that you should be relatively alarmed about at this particular point. Very quickly, just to show you as well, the S&P 500, I think I've already done this one, 46.41 on the ADX. It hasn't turned down yet. We've got the ADX a little lower on the Dow Jones Industrial Average, telling us that the trend itself on the Dow isn't as strong as the S&P 500, but again, it's relatively close to resting here. But what is most interesting, and again, I left this up my sleeve for the last chart in this Monday afternoon market recap, is that the ADX ever so slightly, it has begun to essentially shift, or at least sort of stabilize, right? And it seems to be turning down on the NASDAQ at the moment. So this is a major warning signal. I don't know if I can stress that anymore, but this will generally lead to a market which turns stagnant for a number of weeks, okay? Or it'll sort of reset as the market pulls on back down. And that's exactly the type of sort of gap theory that we're looking at, and also candlesticks that we're beginning to see, not to mention, as I've already recapped, the divergences between some of these markets as well. I think it's very important for you to understand this, to see it, to have someone, explain it to you, and also to be prepared, I guess, psychologically or emotionally for the market to do something which it hasn't done really since December, and that is essentially give back a portion of the gains it's already built in over the first 4 months of 2019. All right, so I hope that makes sense to everyone. If you have any questions at all, please email me, success@pivotpoint-trading.com. Otherwise, I'll see you later in the week, for another market update. All the best, everyone. Goodbye.